Hi, I'm Jim Schubach, and welcome to my YouTube video for Wednesday, May 17th. I hope it's as beautiful where you are as it is here in New York City. It's just makes me really want to go to a ball game instead of working, but let's just grit our teeth because I was at a ball game last week and I got one next week, so I think I can get through this week without any baseball in person. Anyway, and hey, Mud Hens, go Mud Hens! Actually had the occasion to meet someone from Ohio who had never been to a Mud Hens game because he lived in Eastern Ohio and rooted for another minor league team out there, but pretty close. Anyway, if you like this video, please give it a thumbs up. Subscribe to my YouTube channel. That way you get a notification of when we're doing our next one. We do about 3 a week, not always on the same day. If you want more of my stuff, you can go to my free site. That's jubachpicks.com. It's got 3 portfolios for 12 to 18 months, dividends and longer, 5 years or longer. Or to my paid site, which has got 6 portfolios, and we do some ETFs and options, and really long and really short, so more trades, a little bit of trading, and that's jubacham.com. You'll find links to that down below. Okay. With the end of the first quarter on March 31st, all the hedge funds in the world reported their actions, their holdings, exits, and entrances to the SEC, and we're starting to get reports of what was in those moves. This isn't all the money in the world. It's an indication of where thinking is going on, and institutional money, which is sort of important because institutional money really does move the market. And so what I'm seeing is, and the title of today's video is Value Over Growth, that there are outliers in here, but I think the general pattern is hedge fund managers cutting back on their growth stock bets and adding more value plays. So for example, Steve Cohen, who owns the Mets and is a big hedge fund guy at Point72, exited Airbnb, Tesla, Palo Alto Networks, the big cybersecurity, and Uber. Added a little bit of Google, reduced Amazon, reduced PayPal, reduced Visa. So basically, you're seeing there, I think, a lot of moves away from growth stocks. Nelson Peltz, who runs Trian Fund Management, cut Disney, exited Cisco, the big food service company, and added GE, which I would call a value play. Paul Singer at Elliott Investment Management exited all his high yield. He had 2 high yield ETFs, the Bloomberg and Invesco one, and he reduced his exposure to Valaris, which is a symbol ticker VAL, which is an ocean drilling company. One of the interesting filings was from Sorbon Capital partners. They cut Nutrien, the big fertilizer company, and also Mosaic, another fertilizer company, and also reduced their holdings of Canadian Natural Resources. I don't know whether this is all a Canadian thing, because we're talking about a lot of Canadian fertilizer exposure, and completely exited Amazon, Analog Devices, the chip maker, and Suncor, which is a Canadian energy producer in the Canadian heavy tar sands. They added Google. Chase Coleman, Tiger Global, added Google, Amazon, and some Microsoft. Bridgewater, which was founded by Ray Dalio, added Meta platforms, aka Facebook, PayPal, which I call a value play at this point, and Google, and reduced their holdings of NIO, the electric car manufacturer, and Pfizer. So the pattern here, I think, as we go into the second quarter, is to be a little more cautious, to say, hey, we saw some pretty good run-ups in the growth sector in the first quarter, so let's take some profits on those and look for things that haven't gone up as much. GE Capital, maybe some Google, so get out of some Amazon. Still no appetite for chips. And I'm seeing signs here and there that people think, well, maybe energy is not a place to be, so we're seeing some reductions in drillers, Valaris as well, Ocean Drilling, Valaris, as well as Halliburton. Okay, that's the pattern I see as we're going into the second quarter for this market, which I think gives me a sense that people are starting to be cautious, which leaves the market sort of flattish until we get some excitement going on one side or another. Because I don't think people get really excited about value unless it starts to pop, and we're not there yet. So thanks for watching. If you like this video, give it a thumbs up. Subscribe to my YouTube channel. If you want more of my stuff, you can go to my free site, that's jubekpicks.com. If you want 6 portfolios instead of 3, go to my paid site, that's jubekam.com, and you'll find links to those down below. Thanks for watching.